Welcome back to Inside Options. Thanks for joining me, James Boardman. We're talking options trading strategies with a real-life trader, Liang Du from Prescient. He's a fund manager who manages their positive return fund. Earlier, before the break, we were talking about some of the ways, Liang, you use options. So, Liang, up here we've got a picture of a put option. Can you just walk us through that?
Yeah, I think we primarily use the put option to protect equity from downside. And how a put option works is that it's a bit like an insurance contract. So in this example, the stock is priced at 100 and the option costs $10. So you can see that if the market goes up, you just paid away your premium. So if you pay away 10, so your profit and loss, you've lost 10.
Yep.
However, as the market drops, it'll pay you back whatever it drops by to a strike of 100. So in this example, if the market goes down to 90, the option will pay you 10, but you paid 10 in premium, so your profit and loss is 0. Okay. But once you pass that, once you pass the break-even point, you start getting to pure profit.
So you're protected, but it needs to fall 10 for you to make back, for it to have been worthwhile buying that protection.
Absolutely.
So it was only going to fall 5, you would have wasted 5 rand, and
That's right.
your portfolio is going to underperform. So how do you guys manage that? Let's see, I've got another slide here.
Okay. What this just shows is that how we actually put it together in a portfolio. So red line's a normal equity market, and that's always through a 1 year period. So you can see if the market goes nowhere, you earn some dividend yield, and that's about
Exactly.
2%. Right? So the blue line is the same as the put option I just showed before. So when you combine the blue and the red line, you get the green line. So you can see that in this example, it's not quite positive return yet, because all we have is 100% equities, and we protect all our equities by a put option.
Okay.
And obviously the div yield here generated due to the asset valuation with low dividend yield, it's not enough to pay for your protection. So here you got a minus 8% downside, but at least you will not lose more than 8% of your money. And as you can see, as it goes up, you start following you still have upside
Exactly.
of the
But you've
equity.
got that permanent drag of the put option that you paid for that keeps your performance protected.
Yes.
So the nasty bit here is that red line. If the market really tanks, you go straight down if you're just straight in equities. That's if you just bought shares and buying and holding for the long term, hoping for the best. If the market plummets, you're in trouble. But by putting on the puts, you've still got that lag in performance, but you're much safer. So how do you go from that? We still got minus 8% if the market doesn't do much. How do you change that?
I think here we just show two different strategies. So the first thing you can do is, of course, change your asset allocation. So you can't buy that many options to protect 100% of your equity. So what we show here is the blue line. The blue line is solved to have a minimum of 0, spending all the income you have. And in this case, you have about 43% equity.
Okay.
So you can have less equity and fully protect that, and you lose no money. The second way we do that is if vols are high and you still want to be experienced to the equity market, what you can do is sell out caps. So by selling away some caps, the caps generate income for you.
Okay.
So here you can see that the red line is about 60% equities, and you still benefit with the market all the way up to the cap level.
So Liang, let's just unpack that thing you said there, that vols are high. So what does that mean, that vols are high?
I think based on option pricing theory, which I'm sure you'll go through with in this program, as volatility gets higher and higher, the options become more and more expensive. So that premium level that you've seen right at the beginning, where the premium is 10, when vols are high, it could be 10, could be 20 even.
Okay.
But when vols are low, it's only 2 or 3.
So when vols are low, you can get maybe 2 or 3 for that option price, but when vols are high, you can get maybe 20.
Yes.
And for that risk, that's upside you guys are then willing to give up.
Absolutely, that's when the management come into it, because you want to only buy a lot of options when the vols are low, and you do want to sell option when the vol are high.
And I mean, what do you measure that by? Do you look at sort of the historic volatilities? Do you look at the implied, the history of option prices over time and sort of mean reversion? Well, how do you model that? What do you look at?
I think we run a very quantitative process. So of course it's cheap relative to history, cheap relative to itself as well. And of course we also look at the implied versus realized spread. So we look at all of those things, and at the end of the whole story is you also want some equities, because equities over the long term gives you the best returns.
Absolutely.
So suppose, let's say equities valuation are so great that they're going to pay you 50% next year, then you don't mind paying away 10% to protect all your downside. And vice versa, it's the complete opposite. When valuations are horrible, you wouldn't want this, especially combined with high option prices.
Okay, so that's the scary situation there. You've got to make a decision based on whether things are cheap or expensive.
Yeah.
So essentially, whatever you're doing, even if you're trading in derivatives, you're looking for value. You're looking for value in your derivative positions. You're looking for value in the stock market or value in the bond market, shuffling your funds between them. And so far, you guys seem to do a great job on it.
Yeah, I think we've been very successful in that. And like you said, derivatives just add one more dimension. You can see equities cheap or expensive, bonds cheap or expensive, and you can see derivatives cheap or expensive. And then you combine it together to make a portfolio that delivers to your objectives.
Okay, that's fantastic. I like your sort of whole spectrum approach. Can you tell me a bit more about Prescient as a firm?
Sure. We're one of the biggest quantitative firms in South Africa. We recently won one of the Best Manager Awards by the Principal Officers Association in South Africa. Pressing have been around for 13 years, and we started with one client, 100 million rand under management back in 1998. Today we're about 87 billion rand under management. We have 70 people in our offices. We have an investment team of about 15 or 16. Okay,
so you had great growth.
Absolutely.
So, Liang, how do people find out a bit more about these funds? How do they get involved in them?
I think for the normal guy, they can go directly to our website. So if you go to www.prescient.co.za, you can find out a lot of information there.
Okay. And then what's your motto of your firm?
I think our motto is to provide certainty in uncertain times. And what we want to do is, one of the things we say is we're very boring fund managers. And what that means is that we always deliver what we tell our clients we will deliver. And that's what we try to achieve.
Thanks so much for being with us, Liang.
Thank you very much, James.
That's it for tonight. So next week, Jane Beej and I will be back with the next chapter on options trading. Till then, from me, James Boardman, thanks very much for watching. Goodbye.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.